My greetings and salutations to all. In the ongoing series of Finance for Everyone, today we will be talking on meaning of securities. Securities are the financial instruments that represent a creditor or the ownership stake in an underlying organization. They can be bought and sold on the financial markets and are used to raise the funds or invest money by the people, business, and the government. There are two main types of securities, the debt securities and the equity securities. So let me first tell you about what the debt securities are all about. Debt securities such as bonds are a loan made to an issuer in exchange for a periodical interest payment and the repayment of the principal at the end of the term. Equity securities such as the stock indicate the ownership in a firm and allows the investor to participate in the company's earning as well as losses. In addition to these two types, derivative securities such as option and futures and derive their value from an underlying security or the asset. The convertible bonds are an example of a hybrid security that combines the characteristics of both debt and equity securities. The securities are traded on the stock exchanges, over-the-counter markets, and electronic trading platforms. The prices of securities can be affected by a variety of factors, including economic conditions, geopolitical events, and the company's specific news. So overall, the securities play a very important role in the economy by facilitating investment and the capital formation. So let us have a look on this particular slide which shows the types of securities. We have talked about the bonds, the equity, and the derivative market. Now, as per Section 2 of the Security Contract Regulation Act 1956, the security includes number 1, the shares, the scrips, the stock, bonds, debenture stock, or other marketable securities of a similar nature in or of any incorporated company or other body corporates. The second is your derivatives, and the third is the unit or any other instrument issued by a collective investment scheme to the investors in such schemes. Then we have the government securities. The next is such other instruments as declared by the central government to be securities. Next we have a security receipt, and the last is your rights or interest in the securities. Now coming on from the investor's point of view, we can divide the securities in 4 heads: the ownership securities, the debt securities, the derivatives, and the mutual fund. When you talk about the ownership securities, it talks about and includes the shares. The debt securities include the debenture and the bonds, and the derivative and the future mutual funds units. The units are financial instruments that represent an interest in a collective investment scheme called as CIS. A CIS is a type of investment vehicles that pools the money from the multiple investors to invest in a diversified portfolio of securities or other financial instruments. Now, some of the key features of the units are diversification. The units provide investors with the exposure to a diversified portfolio of securities or other financial instruments. So, this can help to reduce the risk associated with investing in a single security or asset class. Next, we have the professional management. The CIS are managed and by the professional fund managers who have the expertise and the resources to make investment decisions on behalf of the investors. The third feature is your liquidity. The units are generally liquid and can be bought and sold on an exchange or directly from the CIS. Next is the transparency. The CIS are required to disclose their investment holdings and the performance, providing investors with the transparency and accountability. The next is your tax efficiency. The CIS are often structured in a tax efficient manner, allowing the investors to benefit from a potential tax advantage. Next we have is the government securities. The government securities, also known as the GSECs, are debt securities issued by the government to finance its financial and the fiscal deficit and the other expenditure. So they are considered one of the safest investment options available in the market, as they are backed by the creditworthiness of the government. Some examples of the government securities includes the treasury bills, the zero coupon bonds, the cash management bills, dated the government securities. Some of the key features of the government securities are the creditworthiness. The government securities are considered to be a low risk investment, as they are backed by the creditworthiness of the government, which is generally considered to be highly rated. Next is your fixed income securities. The government securities offered a fixed rate of interest that is paid out of to the investor at regular intervals. So this makes them a popular choice for the risk-averse investors looking for a steady stream of income. Next we have is a liquidity. The government securities are highly liquid and can be easily bought or sold in the market. They are also actively traded in the secondary market, making it easy for the investors to exit their positions. Next feature is your diversification. The government securities are often used by the investor as a tool for diversification, as they provide a low risk investment option that can help in balance out the riskier investment in a portfolio. Then we have the different types. The government securities come in different types like a treasury bills, dated government securities, state development goals and the loans, and so on. So each type has a different maturity period and the feature. So first we talk about a security receipt, and a security receipt is a financial instrument that represents the right to receive the benefits of the underlying asset held by an asset reconstruction company called as ARC. An asset reconstruction company, that is the ARC, is a specialized financial institution that buys the bad loans or non-performing assets called as NPAs from the banks and the financial institutions and tries to recover the value of these assets by reconstructing them, selling them, or by other means. The ARC purchased the NPAs from a bank. It issues the security receipts to the banks in exchange for the purchase price. The security receipt represents the right to receive the benefits of the underlying asset held by the ARC, which may include the cash flows, interest payments, and the principal repayments from the underlying assets. There are two types of security receipts. The first is your Part A. The security receipts known as a senior security receipt are the priority receipts issued by an asset reconstruction company, and these receipts are issued to the bank or the financial institution that has sold the non-performing assets to the asset reconstruction company. So Part A the senior securities are the senior to part B, that is the security receipts in terms of a priority of the repayment of the underlying asset. Next we have is a part B. The part B security receipts, also known as the subordinate security receipts, are subordinate security receipts issued by the asset reconstruction companies. These receipts are issued by the investor who want to participate in the recovery of the underlying asset. The Part B security receipts are subordinate to Part A security receipts in terms of the priority of the repayment of the underlying assets. The priority of the repayment means that the cash flows from the underlying assets are first used to repay the Part A, that is the security receipt holders, and then any remaining cash flows are used to repay the Part B, that is the security receipt holders. Now let us discuss some of the key features of security receipts. The first key feature is transferability. The security receipts are transferable instruments that can be bought and sold in the secondary market. The second key feature of the security receipts is a fixed income security. The security receipts offer a fixed rate of return to the investor, which is based on the cash flows and the recoveries made from the underlying asset The third is your risk. The security receipts are considered to be a higher risk instruments as they are backed by the non-performing assets. They are often distressed assets. However, the risk can be mitigated by diversifying the investment across the different security receipts. Next we have is a maturity. The security receipts have a fixed maturity period, and after which the investor can redeem the receipts for the principal amount and the accrued interest. Next key feature is your regulation. The security receipts are regulated by the Security Exchange Board of India, called as SEBI, and are subject to various disclosure requirements to ensure the transparency and the investor protection. Overall, security receipts are a financial instrument that allows the investor to participate in the recovery of distressed assets held by the asset reconstruction company. They offer a fixed rate of return but are higher risk instruments and require a very careful consideration before investing. Next we have is a bond, that is right or interest in securities, the mutual fund and the preferred stock. A sort of instrument that denotes the ownership in a firm is called a common stock. The common stock holders are entitled to dividends and the voting privileges. And when it comes to the dividend payment and the asset distribution, in the case of a company's insolvency, the preferred stock receives the preferential treatment. The preferred stock is a sort of security that reflects the ownership in a corporation. Moving on to bonds. Bonds are a sort of security that stand in for a loan to a business or a government body. Bond holders receive the principal repayment and the interest payments. Investing in a diverse portfolio of securities is made possible through the use of mutual funds. Yes, we are talking about the mutual funds. It is a sort of investment instrument that pools the funds of many investors. Next we have is the exchange traded funds, a type of financial vehicles that mimics the trading of stocks and the trade an index, a commodity or a basket of assets. Then we have is the options are a class of derivative securities that grant the holder the right but not the obligation to buy or sell an underlying asset at a given price and a given time. Then we have is the futures are a category of the derivative security that binds the holder to purchase or dispose of an underlying asset at a predetermined price and time in the future. So these examples of the securities, they demonstrate the different type of ownership rights and the benefit that investors can acquire through investing in securities. Then we have the ownership securities. Ownership securities are a type of financial instruments that represents the ownership interest in a company or a corporation. And these securities, also known as the equity securities, they typically take the form of the stocks, shares and the equity units. And when an individual or the institution purchase the ownership securities, they effectively become the part owners of that company. They are entitled to share in the profits, vote on important company decisions, and receive the dividends if the company pays the dividends. The value of the ownership securities is determined by the market demand and the supply of the security, and they can be influenced by the various factors like companies' financial performance, the market trends, and the global economic conditions. Now we're talking about the equity shares. The equity shares, also known as the common shares, are a type of ownership securities that represents a proportionate ownership interest in a particular company. When a company issues the equity shares, it is essential selling ownership stakes in the company to the investors. The equity shareholders are entitled to a portion of the company's profits and in the form of dividends, as well as the right to vote on important company matters such as the election of the board of directors and the major corporate decisions. Unlike the debt securities, such as the bonds or debentures, the equity shares do not have a fixed rate of return. The value of equity shares can fluctuate based on a number of factors, including the financial performance of the company, the market trends, and the global economic conditions. Now, one of the key benefits of investing in the equity shares is the potential for the capital appreciation. If the company performs well, the value of its equity shares can increase, allowing the investors to realize a profit. And if they sell their shares at a higher price than they bought them for. In addition, equity shareholders have the potential to benefit from the long-term growth of the company, and the overall equity shares can be a valuable tool for the investors looking at to participate in the growth of the company and potentially realize the long-term returns. However, the investors should carefully consider their investment goals and the risk tolerance before investing in the equity shares, and should conduct through a research on the company's financial performance and the prospects before making any kind of investment decisions. Now coming on to the features of the equity shares. The first is the ownership. As the part owners, equity shares have the right to participate the management of the company by voting on the important issues and the election of the board of directors, appointment of auditors, and the major corporate decisions. Additionally, equity shareholders are entitled to receive a portion of the company's profits in the form of dividends, which are paid out of the company's earnings. The dividends are not guaranteed and may fluctuate based on the company's financial performance, but yes, they can provide a regular income stream for the investors. The second key feature of the equity shares is a residual claim. As the owner of the company, the equity shareholders have a claim on the residual assets of the company, meaning that they are entitled to receive the shares of the company's assets and the earnings after all the claims, now such as those of the creditors and the bondholders, have been satisfied. And in the event of a company's bankruptcy or liquidation, equity shareholders are the last in line to receive the payment, and after all other claims have been settled. So this feature of the equity shares highlights the higher return risk that is associated with this type of investment, as the equity shareholder have no guaranteed return on their investment and may lose some or all of the investment in the event of a company's failure. Next is your risk. Higher risk associated with equity shares is due to the fact that their value is directly tied to the performance of the company and the broader market conditions. Unlike the debt market, which have a fixed rate of return, the equity shareholders do not have a guaranteed return on their investment and are subject to ups and downs of the market. As a result, investing in equity shares require a higher tolerance for risk and the longer term investment horizon for the potential realizing of the gains. The equity shareholders have the potential to earn the higher returns than other type of securities because they are entitled to a share in the profits of the company. Additionally, as the owner of the company, equity shareholders participate in the long-term growth of the company and may benefit from the capital appreciation if the value of the shares increases over time. So this potential for the higher returns comes with the higher risk, and as the value of the equity shares can fluctuate significantly based on the market conditions and the performance of the underlying asset. Then we have is a preemptive rights. The preemptive rights allow the existing shareholder to buy the new shares before the public. They protect the shareholders' ownership stake from dilution and maintain a balance of the power. However, they can limit a company's ability to raise the capital quickly. The shareholders have a specific time to exercise their rights and can buy the new shares at a discounted price. And now we are moving on to the preference shares. The preference shares are the types of securities that offer the unique features compared to the traditional equity shares. They represent the ownership in a company, but with certain characteristics that make them different from the common shares. So they are often used by the companies to raise the capital without diluting the voting power or the control of the existing shareholders. Unlike the common equity shares, the preference shares typically do not carry any voting rights, which seems that the preference shareholders do not have a say in the management or the direction of the company unless specified otherwise in the terms of the shares. So the preference shareholders are entitled to receive a fixed dividend payment, which is typically higher than the dividend paid to the common stakeholders. The fixed dividend means that the preference shareholders receive a predictable income stream which can be very attractive to the income-oriented investors. So the preference shares are generally very less risky than the common shareholders because they have a higher claim on the company's assets and the income. And in the event of the company's liquidation, the preference shareholders have priority over the common shareholders in terms of receiving their shares to the company's assets. So this can provide a measure of security for the preference shareholders in the event of the financial distress or the overall bankruptcy. So, they have a fixed income, they have a priority over the common shares, they do not have the voting rights, they are less risky than the common shares. So, the last is the debt security. Debt securities are the investment where an investors loan money to a government or the corporation in exchange for the interest payments and the repayments of the principal amount of maturity. The bonds are the most common types, offering again a fixed interest rate and a maturity date. The debtors are similar to bonds but not secured by the assets. So, the other types include the notes, bills and the commercial papers. So, this is basically because in event of the company's liquidation, preference shareholders have priority over the common shareholders in terms of receiving their company's assets. So, overall we can say that participation and the interest, fixed interest are the key feature which differentiates the preference shares from the other type of securities. So, the features of the debts and the bonds is that they earn a fixed interest rates, they have a repayment at maturity and the credit rating, and then it has a issuer, that is the debtors are issued by the companies while bonds are issued by the government or the government related entities. And the last is your priority. In a default, the debenture holders have a priority over the equity shareholders but are subordinate to the bond holders. The bond holders have a priority over debenture and equity holders. Thank you very much.